Today's short video is going to be about how something called the carry trade has been a hidden part of the uranium market for a while now and what it means. Now, I wanted to talk a bit about the carry trade because it is a position that is kind of important to understand in terms of what's going on in the market. And it's a kind of position that not just carry traders have found themselves in. There's a few market participants that are kind of caught in a position that I'll call short uranium. And how did this happen? Well, it's a result of years of oversupply in the market where mines were producing under volume contracts, there was oversupply, there was a demand shock, and all of a sudden demand went away. Traders stepped into arbitrage, and they did this by spot, buying uranium in the spot market and selling it into long-term contracts. Now, they did this, but as I'll get into, they more so focused on the signing of contracts in the promising future supply. Now, again, think about what I mentioned with the arm moving the rope, the wave going through the rope. Here we're talking promise demand to get to the end. People will be, the carry trade has promised to supply future demand. So in this case, mostly they carry this demand forward in that they promise to deliver it in the future and then they have it today. And this allowed the utilities to feel the comfort of having long-term supply contracts and the traders to make the spread in between. Now, the thing is, they didn't, how this works is the carry traders can promise the future demand and then hedge themselves by buying some of it. Now, the important part to realize here is that they have promised to buy the uranium in the future, but they don't necessarily have all of what they promised to deliver. Meaning, at some point along that rope, there is demand that there is a promise to buy something that is already built into future expectations. Now, one of the knock-on effects of this carry trade is that it allowed prices to be kept unnaturally low. It supplied the utilities with contracts, which was comfortable, and this is demand that is filled, but may actually be short in that it is promised to be fulfilled, but it isn't. It's borrowed from the future. Now, the interesting thing is that Cameco, when they shut down McArthur River, they put themselves in the same position in that they had sales commitments, but it made more sense for them to buy on the spot market to reduce the slack in the system and make money without depleting their their prized asset. So they are hedged in that they can in the future ramp up production, and if the price goes higher, well, then that's good for their assets. But the point is, Cameco is now part of the slack in the system in that they have promised future demand from uranium that they don't really have yet. They're going to be buying it. They told the market they're going to be buying it. So this is demand that the utilities are counting on, but that hasn't filtered through to the price on the spot market yet. Thanks for watching, everyone. If you've made it to this point, I applaud you. If you enjoyed, you might also enjoy the other episodes in this series, and they will be all out eventually, and probably some have been released already. As always, Nothing I say is investment advice. This is all just what I'm seeing, how I'm thinking about the sector, and what I view as relevant. So with that, I will leave you there and have a great day.